So, guys, this week was absolutely insane for the stock market. We saw a massive tug of war between pure AI hype and macroeconomic reality. Tech tried to bounce, oil practically broke the chart by crossing $100. Alphabet reported great earnings but still crashed, and AMD fired a massive shot at Nvidia's monopoly. If you are looking at your portfolio right now and wondering why good earnings are causing stock to dump or why the market is acting so weird, you are not alone, guys. The truth is, the market shifts its entire playbook this week. Yes, if you are still trading based on old headlines, you are walking straight into a trap. So, today, let's cut through all the noise, connect the dots, and let's talk about what actually happened in the market this week. Let's start with the heart of the market, AI and semiconductors. For the past years, everyone assumed Nvidia's data center monopoly was completely untouchable. But this week, AMD completely changed the narrative. AMD signed a massive multi billion dollars infrastructure agreement with Anthropic. Under this deal, Anthropic is going to deploy a massive 2 gigawatt compute infrastructure entirely powered by AMD's next generation GPUs across their data centers. In return, AMD is making a direct strategic equity investment of up to $5 billion into Anthropic. So, guys, it's like a building out 1 gigawatt of data center capacity cost roughly $50 billion. So, this is not just a tiny partnership. We are talking about a directional shift worth tens of billions of dollars. And the real kicker is Anthropic's cloud AI will now directly help optimize AMD's software layer. Nvidia's biggest competitive moat has always been its proprietary CUDA software, and AMD just found a backdoor right into it. Now, does this mean the tech correction is officially over? Look at the price action, guys. AMD and Nvidia show some green candles after losing over $3 trillion in market value recently. But the buying volume is incredibly thin. You can see that in front of you. It's very low. In my view, this is just a dead cat bounce. Large institutional investors are using this temporary bounce to trim their risky tech position and build up cash. Until we see heavy institutional buying volume support these levels, every single green day is just a trap for retail buyers. Mark my words, if you want to understand how brutal this market environment has become, just look at what happened to Alphabet and Tesla right after the closing bell. If you remember yesterday, I have already explained in deep. Both giants dropped their Q2 earning reports, and the headline numbers completely tricked retail investors. Google reported a massive revenue beat at nearly $120 billion, and Tesla top line revenue also beat expectations, like crossing $28 billion. But the moment the opening bell rang the next morning, both stocks suffered a brutal sell off. Alphabet crashed over 6% and Tesla stock voluntarily slid by more than 6%, and it's still going down only. Retail investors were completely confused, asking how company can dump after beating revenue expectations. As a trader, you have to look past the headlines and check the receipts. Are you getting my point? Google's net profit beat was a total illusion. It was driven by one-time $98 billion windfall profit from their old equity investments, not their core businesses. Meanwhile, Tesla's adjusted EPS completely crashed by 34%. But the real horror story for both is cash burn. Alphabet confirmed that they are ramping up their full year AI infrastructure spendings to an astronomical range of 195 billion to 205 billion dollars. And Elon Musk, Tesla's free cash flow turned completely negative. Yes, hitting minus $1.09 billion because they spent 47% more on AI research and Cybercab and the Optimus Robo factory setup. Wall Street has officially lost its patience now. Investors are no longer rewarding companies just for saying AI. Yes, They are demanding to see immediate profit margins, while Google has a massive search cache that makes the dip an attractive long term entry point. Tesla is a falling knife, I can say. Buy tech blindly here without checking free cash flow is pure gambling, I can say that. Now let's move to the macro metrics that most investors completely blindfold themselves to: crude oil and US bond yield. If you are only analyzing tech charts right now, you are missing the biggest threat to the entire financial system. This week, geopolitical tension in the Middle East reached a boiling point. The moment the Houthi militia threatened a total naval blockage on Saudi Arabian trade routes, energy markets went into absolute panic mode right now. Banned crude oil surged right through its major resistance and crossed the $100 per barrel yesterday, while WTI jumped well past $90. When energy costs spike like this, the cost of transportation, literally everything on the planet, goes up. This completely reignited the core inflation threat that the Fed Reserve has been trying to fight for years. Because of this inflation scare, the US 10 years bond immediately shoot up to an 18-month high of over 4.7%. Remember guys, this basic rule: when government bond, the fastest asset on earth, start offering a guaranteed risk-free return of over 4.7%, large institutions and hedge funds stop taking high risk in equity markets. They pulled billions out of volatile tech stocks and parked their money safely in bonds. As a trader, my outlook is clear. As long as Brent crude stay anywhere near $100, the Federal Reserve is going to keep interest rate higher for longer. Rate cuts are officially off the table for now, and higher borrowing cost combined with massive energy bill will destroy corporate profit margins. Aggressively buying tech long position here is highly risky, guys. Right now, having at least 15% of your portfolio in cash, energy, or defensive commodities is a mandatory survival strategy. But the fascinating part is the real physical economy is not dying right now. In fact, while everyone on social media is crying about tech stocks, a boring old school industrial company just proved where the real money is moving. I'm talking about Muller's Industries. Yes, you can search it like MLI. This is the ticker symbol. They manufacture copper tubes, brass rods, and industrial valves for plumbing system. They reported Q2 earnings this week and completely blew Wall Street away. Quarterly revenue hit $1.43 billion, up 25% year on year, and their EPS easily beat expectations, coming in at $1.13. Why did this happen? Because average copper prices skyrocketed by over 30% this quarter, is around $6.60 per pound. Retail investors think AI data center only required software. But the physical reality is that running this massive digital grids and cooling systems required millions of tons of physical copper hardware. Look at Muller's Industries balance sheet. It is an absolute strong balance sheet. Yes, guys, they are sitting on $1.42 billion in net liquid cash. They have a current ratio of nearly 5 to 1, and they carry absolute zero long-term debt. Think about the contrast. While tech giants are borrowing billions of dollars of high interest debt just to buy chips, a debt free commodity supplier is quietly making record profits of the physical infrastructure. It proves that you can build all the digital tech you want, but without real world industrial infrastructure, the digital revolution cannot function. So let's look at the bigger picture and summarize the overall health of the market. This week, both the S&P 500 and Nasdaq Composite experience extreme intraday volatility. Yes, technically speaking, the tech index and major names like Nvidia are currently fighting for survival, right at their crucial 50 exponential moving average, and we can say that the 100 exponential moving average. While we saw a brief relief rally to feel some downward grabs. The daily RSI metrics are stuck in a weak neutral zone between 40 to 44, we can say that, showing a severe lack of true buying conviction. My personal outlook for next week is highly, very careful. We are going through a critical reality check phase where the artificial valuation bubbles are deflating and real cash flow sustainability is being tested. With mega cap like Microsoft and Meta reporting their earnings next week, any aggressive momentum trading right here is pure gambling. The biggest lesson from this week is that the stock market is no longer moves on isolated news headlines. AI infrastructure spending is tied to interest rate. Interest rates are driven by oil prices, and oil prices are dictated by global geopolitics. Everything is structurally connected in one giant loop. So, the real question you need to ask yourself is this: are you going to keep chasing the volatile tech deep, or are you going to follow the smart money and protect your capital in energy, commodity, and cash? Let me know what is your strategy in the comment box. If you want to understand the actual macro trends driving the markets every day, hit that subscribe button, guys, and trade safe. I'll see you soon in next breakdown. Thank you so much.